Okay. Hi all, I'm Simona Matra. I'm the Chief Marketing Officer here at Arca. I'll also be your MC for this event. Thank you for all coming to our 5th annual conference designed to educate institutional investors about digital assets. This event was originally titled FO256 and was started by our venture principal, David Nage. Don't know where he is, but thank him for all of his hard work. This event originally started for family offices, but as interest in digital assets has grown along with our audience, we decided to rebrand the conference to be more inclusive. Though these past couple of weeks have been really challenging for digital assets, to put it mildly, one positive for our team is that this conference could not have come at a better time. One of our core pillars here at Arca is to educate our sophisticated investors about blockchain and crypto. And we hope throughout this event, the diverse range of topics and speakers will help shed light on what's happening and what's to come. So one last thing, I would be a terrible boss if I didn't thank my marketing team who has worked tirelessly to put this event together, especially Sophia Jameson. So if you have any questions, all of the marketing teams have marketing at the bottom, and we can answer any of your questions or kind of help you with any of our educational resources that we have put out, or kind of help you figure out what to do. So we hope you enjoy our conference. And with that, I would like to introduce our fearless leader, also known as our CEO and co-founder of Arca, Wayne Steinberg, for his opening remarks.
Thank you, Simona. Guys, thank you for coming here today. Obviously been a very challenging period for digital assets, Arca, our partners. But like Simona said, I wouldn't have a conference like this if you could plan it on a different day. So it's really fantastic to meet with everybody and meet them face to face. So thank you for coming. Before I get started, I really wanted to just relate a story that I think might contextualize some of the challenges that are going on. As you may or may not know, prior to Arca, I co-founded an ETF company called WisdomTree in the early 2000s. ETFs have gone on to gather trillions of dollars in assets, tens of billions of dollars in WisdomTree assets. So a remarkable success in the entire space. What a lot of people don't know is that WisdomTree faced an existential crisis very early on in its history. Like a lot of companies, the 2008 financial crisis hit us very hard. As a company, operationally, we were doing incredibly well. We had just crossed $3 billion in assets under management. Our team was humming. We couldn't be doing any better. Then the bottom fell out of the financial system. We had a publicly traded equity that was trading above $10 a share. And in the drawdown, we traded all the way down to 70 cents. So a nearly 90% diminishment in our market cap, and really was a near extinction level event for WisdomTree. But asset management did not end, ETFs did not end, and WisdomTree didn't end. We survived. Now, the other thing that happened out of the 2008 financial crisis, which wasn't at the time as important to me, but I think is more important for this group, was the advent of digital assets and Bitcoin, and why we're here today. So out of the ashes of the 2008 financial system came the digital asset revolution. And right now we're faced with a similarly challenging macro environment as 2008. All risk assets are experiencing material impairments, and digital assets are no different. The one thing that I would say is different about digital assets, though, is that this is something that's not new to our space. Since the beginning of the ecosystem, we've had 4 major drawdowns. The first one was in 2014 with the hacking of Mt. Gox. This was a $500 million hack, which at the time was a huge percentage of the entire ecosystem, and our ecosystem was written off as dead. In 2016, there was the DAO Ethereum hack, where $60 million in Ethereum was hacked. That's now worth $8 billion, to just show you the changes that a little time makes. But that was also considered as fatal to our industry. A period of tremendous difficulty that I'm intimately aware of was the 2018 ICO bubble bursting. You had $700 billion in market cap dissolution. Into that environment, Arca was founded. So we founded Arca into a crypto winter, so to speak. And that was a period that lasted about a year and a half. Very challenging, but incredibly important for building things of substance. And the last one before the current period was in March of 2020, the beginning of the global pandemic. So these are all periods of tremendous stress in the digital asset ecosystem, but out of them came better things. Out of Mt. Gox, we got Coinbase and Kraken, the largest US exchanges, and solved a lot of the problems of Mt. Gox. Out of the ICO bubble bursting, we got DeFi and DAOs and a whole bunch of other fantastic things. We also got the founding of Arca, so I'm happy about that too. So the point is that these periods of creative destruction are actually really important and are a part of what happens in this space. Right now, we're in the midst of a very challenging environment. Just from April alone, nearly $1 trillion in market value have been erased from our ecosystem. We're down 50% from that period, just in the matter of 6 weeks. So there is no way to make light of or diminish the importance or the seriousness of what's happened. But the important thing is that we're still here, and that is what has happened before in the digital asset ecosystem, the survival, and what comes next. So Nassim Taleb, the author of The Black Swan, also had another concept called anti-fragility. And this is the concept where something that's strong or robust is resistant to forces or resistant to stress. It resists being broken. The concept of anti-fragility, which was such a novel concept, he had to make up a word, is it's not resistant to stress. It's something that actually gets stronger when a stressor is introduced to it. So things that get better when stress is introduced are anti-fragile. The digital asset ecosystem is anti-fragile. You, by coming to a conference like this and participating in the digital asset ecosystem, are anti-fragile. Arca and its partners are anti-fragile. When stresses are introduced to us, we get stronger and better. So that's really the story I wanted to tell you about this. As troubling as these times are, I wouldn't have picked a different date to meet all of you, to meet our LPs, service providers, to have everybody in the same room, to get to talk during a point like this is just a tremendous opportunity and honor. So thank you so much for coming out today. This is a conference about what comes next, where are the opportunities, post-morteming what happened. You can get talk to everybody, many fund managers, service providers, institutional allocators that are here. Interact with them, I encourage you. So thank you again for coming. I couldn't be more delighted to see you. And we're gonna start off our programming now. So I'm introducing our keynote speaker, Tom Lee. Thomas is one of the most widely recognized and followed macro strategists on Wall Street. He is best known for his evidence-based work on equity markets and fast-growing technologies, including digital assets and wireless technologies. Tom has nearly 30 years of experience in macro markets and equity research. He co-founded Fundstrat in 2014, a research advisory firm which has now grown to over 28 full-time employees and serves hedge funds, mutual funds, and family offices in 26 countries. He is also considered one of the most trusted and well-known authorities in digital assets by Syndicator and a top 100 names as a crypto influencer. So thank you very much, Tom. Please welcome him.
Okay, good morning, everybody. I want to start with just a few remarks before advancing my slides. And I would say that the best place to start is Fundstrat is known, in crypto as an advisory firm, but we're really primarily in our roots are as a macro firm. And I think especially what we're seeing in 2022, this is really the intersection and macro plays a bigger role than I think people have appreciated. And you might wonder, well, with crypto where it is today, are things broken or can things get better? And I have a lot of good news to share with you in the presentation, but I also have a lot of bad news. But the best place to start is I think the way we all have to think is really long-term. You know, as they say, when there are losses, everybody becomes a short-term investor. But really, it's in the middle of that carnage that you have to start thinking structurally long-term. And a good place to start is 6 years ago, we first wrote about crypto. And we said that at the time when Bitcoin was around 1,200, that in 5 years, we thought there was using a network value model that we thought Bitcoin could get to 25,000. And for our clients, we advised a 1% allocation. And 5 years later, that 1% became 40% of their portfolio without rebalance. And if they had done half of that in Ethereum, it would have been closer to 80%. So over the cycle, you're going to do a lot better with crypto exposure. So I think as broken as things are, I don't think you want to be structurally too bearish. But of course, everybody wants to know how much more pain do we have ahead and when will the pain end? I don't know the future, but I think the good news is all of this is going to take place before the end of the year. So I don't think we're talking about a winter that's going to last that long. And when we first read about crypto, another thing we noted was the best years for Bitcoin from 2009 occurred when the S&P had good years. So we had a postulation that crypto was actually correlated to equity. So it was actually a risk on asset. And as you know, today, that's pretty widely accepted. So that means if we're going to talk about what happens with crypto, we really have to kind of have an informed view of macro. And that's what my presentation is going to focus on. I do have a few thoughts. And let me just start with what I think are the key things to think about, which is, I think it's all we have to think about for the next couple of months is inflation risk, what the Fed's going to do, and then how much damage is priced into the equity market. Because if you can get comfortable with all three things, that will mark the end of the crypto winter. And when that happens, of course, you know, we're back to the Fed cutting and markets rallying. Okay, so let's dive into this presentation. Okay, first of all, 2022 has been a horror show so far. And you can see this is the S&P from the start of the year. It's been in a straight downtrend. And there are 5 things that have really hurt investor confidence. It's been inflation, the Russia-Ukraine war. We've got a tight labor market. We've got Fed turning quite hawkish. And of course, we have the China lockdowns. And no surprise, if the S&P is down 14% year to date, you shouldn't expect Bitcoin and crypto to be doing well. And that's why, of course, we've heard all the stats, but that's why crypto's lost $1 trillion. And in the midst of this decline, of course, is market liquidity. And I think in many ways, what happened with Luna and Terra is not just a function of a poorly designed protocol, but it really is that as liquidity has dried up across the system, you know, protocols and markets that are particularly vulnerable to liquidity squeeze are going to fall the hardest. And I think that's what we're seeing. So in a way, this is not the start of a crisis from a market's perspective. It's probably closer to middle to end. But this is why you got to put on a long-term hat. This is the S&P since 1930. And what you can see is over the cycle, if we were to live 100 years, that you could see you've never really lost money owning stocks. But I think if you were to use a decade interval and say, okay, what do things look like in the next 10 years? I think we're still in the midst of stocks advancing. And the primary driver for that, which I'll cover, is a very big millennial demographic tailwind that has explained almost every bull market since 1930. So I wouldn't worry that this is the world entering a long-term bear market. I know there's a lot of people prognosticating that, but as you know, markets tend to panic. So pundits will tell you we're in the middle of stagflation and stock returns are going to suffer for the next 10 years, but that prediction has been made at every time the markets turn down. Okay, here's something you should think about, and this may affect how you may even think about crypto. But I think that what is going to come out of this crisis is you have to think about once this inflation crisis ends and the oil surge ends and the war ends, how has the world changed? And my biggest takeaway so far is that we're going to focus on energy security, and which developed nation is a net supplier of energy? It's the US. We're less confident about global supply chains and who is the biggest importer of global goods. It's the US. So I think the US is going to onshore. And now there's concerns about food security because of the Russia-Ukraine war, and the US is a net producer of food. So from the rubble, I think a lot of this realignment and capital flow is going to actually be in the US. And that also means the best performing risk assets coming out of this should be the US. And I think from a digital assets perspective, it only amplifies what's been happening. If regulatory frameworks and really coming together matters, then it's really going to be what happens in the US. So ultimately, everything that's happening in 2022 is only strengthening the position of the US. Okay. Now, I'm going to jump around a little bit, but I think part of what's affecting markets today is that the Fed is in a tightening regime, and the US is now exiting a period of extremely low interest rates, one that's been declining since 1982. And the natural question everyone's having in their minds is, okay, well, if rates are rising, shouldn't the PE of the S&P come down? And if that's true, then it's going to compress the valuation of other things that are high beta, including crypto. So here is a chart that I think you have to keep in mind. The top is the 10-year, okay? And I've marked it with just some decade periods. But for the 20-year period into 2008, the 10-year averaged 5.3%. And for the last 12 years, it's averaged 2%. So I think it's fair to say if we're in a world where inflation is no longer 2 and the Fed is a little tighter and now we have structurally turning higher interest rates, let's say the 10-year gets back to 5%, where it was for the prior 20 years. Well, take a look at the PE. The PE averaged, okay, you can't see it. In the 20-year period into 2008, the PE averaged 17 times. And the PE over the last 12 years averaged 17 times. The stock market's multiple probably will be the same, even if the 10-year gets to 5%. This is not what the market's saying today. That's why markets are under selling pressure in the S&P PE 16 times. But I don't think stocks are actually going to continue to derate. In fact, I think stocks multiples are going to go up. And let's talk about the Fed, because this is all central to the process. The top chart is the Fed funds rate, and the bottom is the 10-year. And so far, the Fed's raised, 75 basis points. This chart was prior. I just want to make a point prior to the Fed raise, but the Fed has raised 25 basis points before April. And you can see the 10-year rose by 1.3 percentage points. Now, what that means is the Fed this time has made modest changes in monetary policy, but they've clearly communicated what they want to do, and interest rates have moved huge. Now, why am I actually highlighting this point? Well, take a look at how the markets reacted to prior Fed cycles. In 2004 to 2006, the Fed raised rates, okay, this first set of charts, 100 basis points over 12 months. And in that first 12-month period, financial conditions eased and 10-year fell and mortgage rates fell. In other words, the market was ignoring Fed hikes, so the Fed had to push rates higher before financial conditions tightened. And the same thing happened in 2016. The Fed raised rates for 100 basis points over 12 months, and interest rates fell, financial conditions eased, and mortgage rates fell. So monetary policy had no effect in the first 100 basis points. Today, the Fed raised 25 before April, and interest rates surged, and mortgage rates surged, which means the Fed's monetary policy is now being transmitted almost immediately. So I think the way I would take it is the financial markets are doing the work of the Fed. Powell made that same comment yesterday. And it raises the probability that the Fed doesn't have to do the entire 10 hikes through the end of 2022. So as an opinion I would share is I think the Fed's not going to, I think the Fed could be even considering cutting rates before the end of the year. Okay, now you might say, Tom, don't we have an inflation problem? I mean, yes, we do have an inflation problem today because inflation is visible. But a lot of this is not necessarily structural, but it is cyclical. And cyclical meaning it's driven by supply chains or policy. And I think one of the best places to see this is actually the labor market. The Fed's the most worried about wage increases. And a way to see how tight the labor market is this chart. The bottom is labor utilization, which is the number of people working relative to the total population of people of working age. So you've heard a lot of anecdotes like this is the tightest job market in history, which is the Fed's characterization. Or you've talked to people who say it's impossible to hire workers. So it's true that the labor market is tight currently. But there is something that doesn't sort of foot to actually the aggregate data. Today, about 60% of the total population of people of working age are actually working. So today, 40% of people that are eligible to work aren't working in the US. This is a chart showing the last 60 years. In the last 60 years, 60% employment to population ratio is normally what you see in a recession. So there isn't a lot of utilization of people, yet there's a lot of people not looking for a job. For instance, this chart might surprise you too. Since the end of 2019, okay, so before the pandemic started to today, despite what people say is the tightest labor market in history, there's actually 684,000 fewer people working. So we have fewer people working today, but it's considered the tightest labor market in history. For those who are in New York, you can see this in Midtown. Midtown retail vacancy rates are close to 40%. Okay, and you have to keep in mind retailers employ close to 25% of all Manhattan workers. So if 40% of these are closed, you should have a huge supply of unemployed people. Yet, as you know, go into any store today and they say it's hard to find workers. So there is something that I can't explain, but there's a lot of people that could be working that aren't working. You know, it could be overly generous unemployment benefits. It could be people took early retirement, but for whatever reason, there is really not a shortage of people eligible to work, but there aren't enough people working. But I highlight something here. And again, I think this is key to understand because this is where labor markets could start to ease. Most of the hiring since the end of 2019 has been in retail. There's been 1.4 million jobs added in retail since the end of 2019. That's close to 30% more people working in retail today than at the end of 2019. Guess how much retail sales have grown since the end of 2019, adjusted for inflation? It's grown 11%. So the retail industry has hired a lot more people than the growth of sales, which I think you've heard it from Target, Amazon, and Walmart. They have hired a lot of extra people because of protocol risk from COVID and Omicron, that they didn't want to have any outages. And so I think as these are overstaffed companies, we could start to see the labor market break. And that would be very good news for the market. It's an instance of bad news is good news. And let's see, I want to jump ahead to a demographic question. And this ties to, again, wage inflation. Well, actually, I'm going to skip that because I do want to cover, oops. Okay, I think there's a glitch. Oh, here we go. But that being said, I think inflation is going to start rising in the US. So I don't think 2% inflation, which the Fed has been targeting, is realistic. And there's a couple reasons for that. Number one is this is a long-term trend of inflation since 1917. And I've drawn a trend line of the CPI line. And you can see for the last 12 years, we've been below trend, which means if we only approach trend line on CPI, that means we're adding 100 basis points a year. So even if the Fed wants to keep inflation 2%, that means you're going to have this trend line actually widen versus the long-term history. And I'm going to actually try to jump all the way to the end of this deck. To explain why I think inflation, oh, here we go, okay. And this is the reason. If you look at core inflation, 10-year rolling, that's the orange line here. And you can see it's actually been quite cyclical. The reason for this is we believe is actually has to do with aggregate demand by people of prime working age. And that's the top line. This is the number of people aged 30 to 50 in the US since 1930. And you can see that for every, it's quite cyclical, but it actually has to do with generations. So we had a surge in inflation in the 70s, which let's see if I can highlight this here. Oh, I think the battery on this is actually dying. That's why it's not advancing. That's related to the baby boomers, and you can see core CPI rose. But for every baby boomer that existed, there was only 0.8 Gen X, so the generation behind the boomers. And therefore, as you had a slowdown in the growth rate of people aged 30 to 50, you had a downturn in inflation. For every baby boomer, there's 1.2 millennials. And that means, as you can see, this suggests that inflation should actually start to rise. So I had my data science team calculate what is the influence of population growth of people aged 30 to 50 on what core inflation should be. And their calculation is for the expected growth rate of a cohort, people aged 30 to 50 over the next 10 years. Inflation will run 2.5 percentage points above that. The reason we had 2% inflation for the last 10 years is that the number of people aged 30 to 50 was actually negative. So if you add 2.5% to that, you're going to, of course, have some core inflation below 2. If the number of people aged 30 to 50 is going to be somewhere around 2 or 3%, then core inflation has to run higher than 3%. And I think that means the Fed's goal of 2% inflation is going to be difficult to achieve. And that's one reason, again, I would say that I don't think the Fed needs to do all the hikes it's planning to do. Okay, so I'm going to just jump back now. And get back to some views on market valuation. So as I mentioned before, I think if the 10-year gets back to 5%, I don't think PEs are going to derate. So I think stocks have priced in a lot of bad news. And the Fed's already has less work to do because the markets have already priced in a lot of hikes. But I want to sort of corroborate that with a piece done by JP Morgan, and they looked at equity risk premia since 1920. And what they highlight is that equity risk premia is stable across interest rate regimes. And their takeaway is that interest rates could still rise 200 basis points from here, which is 3 to 5%, and equity risk premia would be stable, or PE is stable. So again, we're at the point now where equities probably won't lose you money. For those who are clients of Fundstrat, we published a piece today looking at an internal metric of equities, which is the percentage of stocks trading below their 200-day moving average. And that number reached 21% earlier this week. That means that 80% of stocks are trading below their 200-day. Now that number did get lower in 2008. That number actually hit 0%, we're above their 200-day. And in 2016 to 2018, during that growth scare, that number fell to 10%. So you hear a lot of folks who are particularly or technicians saying that the market hasn't yet capitulated because they think there is another wave of selling down. But here's what's interesting. For those who are users of DeMark analytics, I'm a big fan of Tom DeMark. In fact, I'm having a webinar with him tomorrow. So if you're a client, we actually have a webinar with Tom DeMark, who called the March 2020 bottom to the minute. We did a webinar that morning because of his urgency about saying the markets have bottomed. Interestingly, he did want to do a webinar tomorrow. So I wonder if the timing is coincident. He actually wanted to be on Kramer Friday. For those who use DeMark, there was a DeMark 13 on Friday, which is a sell exhaustion signal. So, and as you know, markets really turned almost on a dime on that day. But here's what's interesting. If you use DeMark analytics on the percentage of stocks trading below the 200-day moving average, that has registered a 13. So it's a buy setup. It's contrary to how most people think, because most people want to see this number get to 0%, but it's already posted a DeMark 13. And in our piece this morning, we just highlighted that 13 appeared at exactly the low of that metric. So it takes a lot to get a purple 13 on a series that's measuring market internals. And similarly, I saw a piece, and I didn't do it myself, by another strategist that showed that CPI is posting a 13 as well, a sell setup. So I do think inflation has peaked. I've got some slides here, we can jump back to it. And if that's the case, now the question is just how quickly is it going to come down? And I think if the economy weakens, it should come down quickly. But jumping back to this 200-day, it gets us to a really interesting question, which is, what is the chances of you losing money owning stocks over the next 12 months? Okay, so in other words, if this number is at 21% and ignoring that it's a DeMark 13, so let's say that you don't think it's even bottomed, it's just at 21%. So let's say you have a buy program that buys stocks every time the percentage of stocks below 200 gets to 21%. Since 1994, your median return over the next 12 months is 26% positive, and you've only lost money 11% of the time. So we're now in a zone for equities where you can't really lose money over the next 12 months. And that's why, if I was to say, where are we in risk markets, it really now is a question of, are you a long-term investor or short-term? Because in the short term, I think there could still be some risk of pain. But if you're a long-term investor, this is your first chance really in almost 3 years to have 20% expected return potential in risk assets. And another way to think about why markets aren't really thinking clearly is this chart. This is it's a scatter chart of the S&P, and the x-axis is revenue growth, and the y-axis is PE multiple. On the left side, this is November 2021. That's really when the internals of the market peaked. The NASDAQ peaked. And you can see at the time, stocks with higher revenue growth, revenue growth this way, had a higher PE. So it's positively sloping. And that actually makes sense. That's what you expect in markets pricing risk appropriately. But you can see as of today, the opposite's true. Companies with negative revenue growth have higher PEs than companies with positive revenue growth. It's just highlighting that the stock market isn't using price discovery as a basis to value stocks. It's actually just selling whatever's liquid. And of course, people are overweight growth, and so growth stocks are selling at a discount. Now, on the front end of that, of course, is crypto. So if growth investors are selling growth stocks at any price, then no one's going to be buying crypto at any price. And this is also true of free cash flow. You can see on the right side, this is even more inexplicable. Companies with higher revenue growth trade at a lower free cash flow multiple than companies with negative revenue growth. I mean, this is the exact opposite of what you expect, because if you're growing free cash flow, you should have a higher multiple, and the exact opposite is true today. And on slide 25, I'm going to address something that I think ultimately is something the market's not thinking about, which is I think that there is a chance that structural inflation in the US is going to be 3.5% or more. And it'll take some time for policymakers and the markets to, let's say, accept it, because everyone's using a bogey of 2%. And that means interest rates likely are below inflation. So we're going to have negative real interest rates. And you might say, Thomas, first of all, is that even possible? Keep in mind that Japan has had negative interest rates real for the last 10 years. And Europe has had negative real interest rates for 8 of the last 10 years. The US has not had negative rates in the past 10 years until recently. But here's what might surprise you. Since 1870, 26% of the time, the US has had the 10-year below CPI. So as much as we think that inflation rising here and the 10-year being low is an anomaly, and it is kind of an anomaly. It's not as anomalous as you think. Roughly 25% of the time over the last 130 years, interest rates have been negative. And they've occurred in 3 periods. The first one is sorry, I can't really see it. There's 3 epochs, but the last two are 1942 to 1969, and then 1917 to 1928. So it's not as if negative real rates are anomalous and they only appear 1 or 2 years and the Fed has to panic and raise rates. They can actually be epochal as long as markets aren't panicking. But this is what's interesting from a equity perspective, and of course this affects crypto. If real rates are negative or real rates are lower than people realize, in other words, we're not really at what they call neutral, that means companies should be able to borrow money and at negative interest rates and then earn real money. You should be long equities. And that's indeed what's happened. You can see here, since 1870, in the 3 periods of negative real interest rates, stocks have gone parabolic. So again, in the short term, when people are losing money, they become short-term investors. But from a long-term investor perspective, this is actually still a great environment to be owning equities. And in the meantime, of course, bonds are going to lose you money. And so it's another reason why you have to wonder why you'd be allocating to bonds. Bonds have actually had negative real returns many times in the past 100 years. They're not actually a store of value or a safe haven. And you might ask, oh, how much money is in bonds today? Today, just in the US alone, households own $55 trillion worth of bonds. GDP is only 22 trillion. So think about that. Households own 2 bonds for every dollar of GDP. They are massively overweight bonds today, which are set to lose money over the next 10 years, especially if the Fed's going to raise rates. Incidentally, if you owned a 30-year bond in the last 18 months, you've lost 50% of your value. Okay, so bonds have already been massacred. But it's also a threat existentially to the bond industry, because the bond complex really only makes money if bonds have positive return. I mean, and the bond complex are bond managers, investment banks that trade bonds and issue bonds. That's a huge industry that won't make money if interest rates are negative. And I think that's one reason why the credit market is arguing for the Fed to push us into a recession. Not necessarily to get rid of inflation, which is a good goal, but that's the only way for interest rates to fall. So I think that you have the bond world rooting for a recession for self-serving purposes. And here you can just see clearly the trend that anytime real returns for bonds turn negative, which is the gray line. Yeah, this is busted. The savings flow into bonds actually falls. So if bonds are set to actually have declining returns, the bond industry is in trouble. But here's the question, where does that money go, right? I mean, it's $55 trillion. Well, just look at the last 10 years. Households plowed $3.7 trillion into bonds, and they barely put money into the equity market. So once the dust settles, you have to ask yourself, are you going to expect households to suddenly reload on bonds that are down huge and likely can't even beat inflation, or are people going to buy things that protect them from inflation? So I think in a way, well, again, once the dust settles, you have to think about TINA, and that's good for the equity market, which in turn is good for crypto. And finally, let me just highlight some demographics issues here. Okay, and I think the last point I just would make is that it's important to think about the role of millennials and why they're probably much more important to both the economy and to the stock market than we realize. It's something that we've talked about since our earliest work on crypto, and I think more strategists and more pundits talk about it today. But not surprisingly, the prime age workforce, such as people aged 30 to 50, doesn't grow at a steady state. It's actually quite cyclical, as this chart shows. And again, as I pointed out previously, because of the smaller size of Gen X, the number of people aged 30 to 50 was actually declining and went negative. By the way, this bottom here is 2008. That was the bottom for inflation and the bottom for financial markets and the bottom for housing. And you might wonder, well, does this chart actually have any influence on how financial markets perform? And I'm going to overlay the rolling 10-year return of the stock market to the rolling 10-year number of people aged 30 to 50. And you can see it's almost the same exact chart. And if that's true, just using a simple projection, that does mean by the end of 2020, by the end of this decade, by the end of 2029, the S&P could be at 19,000 and the S&P is at 4,000 today. So despite a rocky start, I think we're still talking about equities having potentially explosive returns into the end of the decade. But you might ask, why does this happen? I think it actually has to do with this chart, which is today, all the great companies that we think about, that are blue chip, Bloomberg, Blackstone, Home Depot, Costco, Cisco, Apple, Oracle, United Health. These are, blue chip giants today driving the US economy. They were founded at a time when their founder was in their 30s. Okay. All great companies are being created by people who are in their 20s and 30s today. So that's the mismatch in the economy, because the financial markets are controlled by people in their 40s and 50s. And people who have money saved, okay, what we call savers, are generally over age 60. 76% of all the wealth in America is controlled by people over age 65. So money is controlled by baby boomers. It's managed by people in their 50s, of which both of them have kids in their 20s, and they think their kids aren't really useful. And that's why they're always structurally bearish on the future. But I'm going to say the opposite's true, which is that, these people in their 20s and 30s are actually the ones who are going to innovate. Because one, they're the ones that see the problems. And they're the ones that are going to be really creating things. And there's a way to sort of quantify it. That top chart is the number of people aged 30 to 50. And the bottom is rolling patent filings. And as you can see, even patent filings, which is a measure of innovation, tends to be cyclical, that follows the number of people aged 30 to 50. So I do think this means a lot of great things are being created by young people. And then from an asset allocation perspective, you want to make generational bets. And that's what this chart highlights. If in the 80s, the boomers from 1982 to 2000, they really transformed retail because they became consumers. And there were many factors behind that. But one of them was women entering the workforce. And the fact that boomers were a much bigger generation than their parents. I think there were 1.3 boomers for every silent generation, which means you had to increase the retail capacity at the time. And what did that mean? Well, it meant consumer stocks were huge outperformance. The S&P actually had a 16 times return, but the top 7 consumer stocks had a 117,000% return. That means $1,000 in consumer stocks had turned into almost $1.2 million in a generation. And then, of course, Gen X, which is a smaller generation, was really big into internet. And if you bought a basket of the 100 largest internet stocks in 2000, 96% of could have gone to zero, but you still had a 16 times return. You still beat the S&P by 5 times. You could have been a bad stock picker, but if you just made a generational bet, you would have outperformed. And so I think the question we need to ask today is, millennials are only beginning to exert their influence in markets and the economy, and what do they care about? And I'm sorry, it's not in here, but it's clear that they care about digital money and digital disruption. I'm going to conclude with just a really simple high-level reason why. Like someone might say crypto isn't that useful because it's mainly used for speculation. And it's sort of true because today crypto usability is really being constrained by legacy financial infrastructure. So the biggest obstacle to crypto today is really that the banks want it to die. And why do the banks want it to die? Well, most people here, you're not crypto necessarily skeptics, but in the majority of our meetings with investors, they're pretty skeptical of crypto because they think banking is actually quite cheap today. But for the average American spends $2,700 a year to use the average banking fees they pay is $2,700 a year. That means the average American spends 3.5 weeks a year for the right to have a bank account. That's more money paid to the bank than they do in taxes. And by the way, the banks barely know them. Facebook knows more about you, and Facebook makes about $99 a year from you. So if you think about why technology companies who they believe know a customer better and can make better credit decisions care about digital money, it's because it would allow them to disrupt an industry that makes $2,700 a year per person. And by the way, the bank stocks already reflect the risk of disruption because they basically trade at book value. And fintech and tech disruptors trade at almost 20 times. So I think that the markets have already recognized that money is going to be disrupted, but there is a pretty big regulatory obstacle in the US. I think that there's a good chance, this is sort of just a guess, that future money, including a future central bank backed digital currency, is not going to be the Fed dollar. It's probably going to be the digital ECB because so much is at stake for US banks. So with that, I think I'm going to wrap up. I don't know if there's any questions, but I don't want to keep the conference behind schedule either. Yes. Yeah, that's a great question. The question is, if we take away tariffs from China, would that actually reduce inflation in the US? Yes. There's actually a lot of half-truths out there about inflation. And one of them is that companies are responsible for inflation because companies are raising prices to consumers, and therefore you have inflation. As much as most people will dismiss it as a liberal thesis, it's actually mostly true, right? Because if companies had margin compression, then they'd be the ones absorbing inflation, not the consumer. Because consumers don't buy corn, they buy cereal. So inflation is transmitted through the supply chain. Incidentally, a $4 box of cereal Guess how much is the total cost of all the corn, sugar, and agricultural products in that box of cereal? Yes, yeah, that's right. It's about 25 cents. I mean, today, most food you buy today, you're not paying for the underlying commodity. You're paying for someone's profit margin. So yeah, so if the tariffs is one way, raising taxes on companies probably is another way. These are not economic. You're not solving the underlying problem, but it would help inflation. I mean, the underlying problem, which is cyclical, is not that there's too many people. It's that there's a supply chain disruption. In fact, I just want to highlight something that I think it's becoming better known, but at the time I don't think it was as well known. But like when you hear we had a 6% CPI print, right? And everyone thinks we have a huge inflation problem, and we do. America does have inflation, but of that 6% inflation, okay, used cars and new cars were 2 percentage points. So inflation was 2 previously, now it's running at 6. It increased by 4%. 2 percentage points of that inflation is car prices. I mean, think about how crazy that is. I mean, that's not, used cars aren't going to rise another 45% next year. And if they don't, as you can see, just that means that almost half of the increase in CPI is disappearing this year. Now, other things are rising in price, like food and gasoline and shelter, and they're moving their way through the pipeline. But it's one reason why I think you can probably make the argument that CPI probably has peaked in the US. This is showing you used cars in the gray, and the blue is the projection of CPI, used car impact on CPI. That's a 2-month advance, meaning used cars have fallen enough that in the next 2 months, you're going to see almost a collapse of the CPI contribution from used cars. And another way to look at that is the Cass Freight Index, which measures shipments. So when goods are moving, Cass Freight shipment prices should be high. The Cass Freight Index is actually now negative year over year. So the cost of moving goods has actually dropped. You can see it in freight rates and port traffic. But as you can see, that leads CPI too. So by 6 months. So CPI should be falling. And if that's the case, the Fed has a lot less wood to chop, but that would be the best thing to see inflation break. Yes, the question is, how do we think about policymaker overreaction? And I think it's both the Fed and governments. Dan Loeb makes a really famous statement. He says, when policymakers panic, that's when you need to buy. And because by the time policymakers panic, which the Fed's panicking now, and the government's soon going to panic, that's already priced into markets. Now, that's not a consensus view, right? Because if you talk to most people, including technicians, they think there's downside ahead, which they could be correct. But the downside, let's say that the markets have 5 to 10% downside from here. Okay, and I think it's possible. It's a touch, it's just like what happened in March. Like, let's say in February 2020, someone said, okay, markets could go down another 10%. Like if you had perfect foresight, and in February 16th, 1 month before the bottom, if someone told you the markets could go down 10%, would you want to be selling everything and trying to go short so that 30 days later you can cover and go long? Or would you have been better hodling? Looking back, everybody who panic sold in 2020 are the ones that actually suffered wealth loss, and everybody who stayed long actually got the benefit of the rally. I think that's where we are today. I don't know if I can tell you how much downside there is, but I don't think you're going to lose money in the next 12 months. Yeah. The question is, if the CPI is starting to roll over, I think directionally it's going to roll over, but I don't know how fast. when would the Fed start cutting? Here's the thing. Powell made the statement very clearly yesterday, and I'm going to repeat it, just from my head. I don't think I got it exactly right. He says he's not going to look for signs of nuanced inflation improvements. He needs to see it decisive. So it's really, when will inflation really come down, which he hasn't defined. I think the used car thing is gonna show up very quickly. In fact, that labor market's already showing a lot much greater weakness. Again, if you're a client of Fundstrat, we highlight today, like if Indeed.com, which is the job posting, actually posts daily jobs open. The JOLTS data, which the Fed talks about job openings, is only published every month. The JOLTS data the Fed cited at their FOMC meeting last week in May is March 31 data. The JOLTS report is 6 weeks late. So they had the latest JOLTS number on May 6th, but it was only through March 31. Indeed.com has had now 8 weeks of additional data since March 31, and it shows the job market's rolling over pretty hard. So I think the Fed would love to see the labor market weaken. Wages are already weaker. I think Target, Walmart overhired because of COVID. So that's helping the constellation. But I think that they want sticky inflation to be cooling. So I don't know. I would just say, I think the stock market's going to sniff it out eventually. Look, China's bottomed. That's kind of interesting. And semis are rallying. So I think things feel bad, but they may not be bad they won't be as bad in 6 months. You know what? I think there's a possibility that they're going to do 2 more hikes, which they're baked in. Okay, so they'll take Fed funds to 1.75, or maybe 2. Okay, and the market thinks that we're going to get to 3.25. The long bond has priced in 3%. That may be the ceiling for the Fed, even though neutral might be 3.5 or higher. So I think, will the Fed make a dovish pivot before the end of the year? Yes. I don't know how quickly. But the stock market doesn't have to wait for the Fed to make the pivot. They just have to see the data. And again, that's why everything's hypersensitive to every data point. Yeah, it's a great question. I've been in markets since '93. So I was live living through the .com bust and through the housing crash. Okay, and everyone has a different perspective on why that happened. But I have to remember in 2008. 2008 was really built up because of the response to 9/11. Because at the time, the economy kind of hit a wall and nobody wanted to buy anything. And policymakers thought, well, why don't we just try to stimulate housing? Because housing hadn't done anything. But this chart just shows it was really the wrong time to be trying to stimulate housing, because the number of people that would actually be able to buy a house was actually declining. Oops. Sorry, okay. You can see number of people age 30, 50 was actually falling. But housing had a huge bubble, and then it created a whole financial complex to support housing, because home prices only go up because they were going up continuously, and create a bubble. That's really the bubble that had to be fixed. And in this crisis, if you ask me what bubble is really bursting, okay, a lot of people think it's like the Reddit stocks, or they think it's crypto, but I actually think it might be China, because China was a beneficiary of the global outsourcing, and people thinking a non-capitalist driven economy could actually be trusted to be a supplier to the rest of the world. So I think the realignment is away from China. That's probably that'd be my guess. And there's a lot of stranded capital there. I mean, that's the place you're going to lose a lot of money as people onshore. Thank you.